2-1 buy down, getting a mortgage that is 2% lower, 2% APR lower the first year, and 1% lower the second year. It's known as a 2-1 buy down. Folks, this has become very popular in the last few months. Anthony Lamacchia here, broker owner of Lamacchia Realty, and I am here to talk to you about this creative mortgage option that many buyers are looking at, many buyers are curious about, some buyers are confused, even some realtors are confused. And even though I'm not a mortgage broker, Lamacchia Realty is not a lender, I'm here to go over the numbers with you, and I am here to explain it all to you. So let's break it down. I just put all the numbers up. I'll bring you straight to the blog that goes over our rate buy down. And if you take a look, it talks about a purchase price of $500, and then it talks about a loan amount of $400. So those are the numbers that I put up here. And what I did for the purpose of writing your offer, because that's where people are getting confused. If you're going to make an offer, you'd offer $515,000, okay? You'd get a 3% closing cost, which is easily allowable for a 20% down conventional loan. You actually can go up to 6, but for this example, I did 3. 3% closing costs, I wrote in $15,000. Obviously, $515, there's a little change in there, but who cares? Let's go with 15. Now, if you look on the page of the mortgage rate buy down, you will see it says subsidy amount $9,103. For the purpose of this, let's just say $9,100. That's the amount of money that's going to be held in a separate escrow account and go towards your payment, and that's how you're going to get a lower payment. But let me just keep going through the purchase numbers, and then we're going to get to all that. So the net price is $500. That's the price the seller cares about. $515 per offer price, closing cost credit $15,000. $500,000 net price, down payment $103,000, which is 20% of $515, loan amount $400. All right, follow me so far. Now, some of these numbers you might say, wow, that's another cent. Who cares, folks? I'm doing an illustration here. I'm trying to keep the numbers round and make it easy on all of you. But this would put you in a position with a $400,000 loan that the normal payment would be $2,528. For the purpose of going over on the board, I simply wrote $2,500 right here. Normal payment, $2,500. You as a buyer have to make sure that you can actually afford that. Okay, realtors, no realtor you work with, certainly no realtor at Lamacchia Realty, but whether you're working with someone in our company or another company, you shouldn't work with a realtor that would tell you, hey, don't worry if you can't afford the normal payment because the payment's going to be lower in the first year or two. Folks, no. You have to actually be able to qualify for the normal payment and know that you can pay it. And then the first couple of years having it lower is a benefit, okay? So if you take a look, you'll see the first year, the payment's roughly $500 less, okay? So instead of being $2,500, it's $2,000. The second year, the payment is $2,300, which is roughly $200. It's actually like $257 less per month, okay? I could change this to a 5 right here, 7, okay? You guys can read that, right? So that brings your payment down. The way this works is this, little mortgage lesson, most mortgages are required to have what's called an escrow account. The escrow account holds typically the insurance and the taxes, the annual taxes that need to be paid, the quarterly taxes that need to be paid to the town or county, wherever you are in the country, and then the annual homeowner's insurance policy. So each month when you make a mortgage payment, remember, little mortgage lesson here, most of the payment in the beginning year, in the early years, goes to interest, some of the payment goes to principal, and then some goes to escrow to pay these bills as they come in. What's happening with a buy down is there is a separate escrow account right here. That's where that $9,100 goes, and it sits, and then each month for the first year, see my arrows here? $500 a month gets taken out and gets put towards your payment. That's what brings your payment down, and the beauty is you're doing it through a closing cost credit that you're getting from the seller. Same thing the second year, $2,300 roughly, or $2,271, whatever. You guys know the numbers. I told you these were rough numbers. Comes out until this account is literally down to $0, or I could have even said 0 cents. That's how it works. And then hopefully by that third year, you know, if you have to pay the full payment and rates are still high, fine, you pay it because you'll be able to afford it because you wouldn't have qualified in the beginning if you couldn't. But more so, the chances of being able to refinance 2 or 3 years from now are very high. You look at when interest rates went up in the early 80s, mid-90s, mid-2000s. They were up 2-3 years and they came back down. We don't expect this to last forever. So again, I, Anthony Lamacchia, am not a mortgage broker. Lamacchia Realty is not a mortgage lender. But I hope this helps you have a better understanding of how it all works. We have an extensive blog on it with many details where we do take things down to the penny. That's all. Good luck. Happy home buying.